Yesterday, I spoke with an individual who owns a small business in New York City. Him and his brother own and operate the company. It's been around for more than 50 years. And again, it's in New York City, so it's a family business that's been around for a long time, which is always cool to hear. Now, right now, they've got a buy-sell agreement where one of the brothers has a $500,000 term life insurance policy on him in case anything happens to him. This way, a death benefit can be paid to his wife, and the other brother can continue to own and operate the business. Now, with that said, they asked, can we get a whole life insurance policy instead? As one of the brothers personally owns a whole life insurance policy, and he likes what he has been able to do with it. And the answer is yes. However, they want to add more money than just the minimum to the whole life insurance policy, which leads into a very common question, which is this: why would I add more money to a whole life insurance policy, especially if I just get life insurance with it? We'll answer that question here because we get more than life insurance. So a little bit of information. This individual is 54 years old. And what I'll start with is if we just get a basic whole life insurance policy, it's going to be expensive to the point where I would say I would not do this, especially when we compare it with your term policy and what the premium is for that term insurance policy. But why they're interested in a whole life insurance policy is because he can get the life insurance, the death benefit that they're interested in, which is going to be $500,000. And he can get some cash value, or I should say a lot of cash value, and we'll talk about why he's interested in that too. So a little bit of background on him. He owns a small business with his brother. Right now they've got a buy-sell agreement, and a $500,000 term policy is part of that buy-sell agreement in case anything happens. The premium for that term policy is just under $2,400 per year. And he asked, can I have a whole life insurance policy instead, or can we use a whole life insurance policy instead of a term policy? But we'd really like to make sure that we still have a $500,000 death benefit for at least the next 10 years. That is an important time period. We need to have that to fulfill the buy-sell agreement. So the answer to the question is yes. However, there are some things we want to be aware of. So the first priority is making sure we get the $500,000 death benefit for 10 years. Now, he can get just a basic whole life insurance policy, meaning he can call up a life insurance agent or a life insurance company and ask, how much would a $500,000 whole life insurance policy cost me at age 54? And the answer is, it'll be very expensive. Let's take a look here. So here's a page from an illustration for him of a basic old school whole life insurance policy, which I by no means would recommend doing. But when we look at this, we see that the death benefit in the far right is $500,000. So they have the life insurance to satisfy the buy-sell agreement. However, we mentioned that it is expensive. For that $500,000 of coverage, it costs him $18,000 per year. The first year, he pays $18,000. He has $500,000 in life insurance, but here's his cash value. Almost nothing, $600. And he continues to pay $18,000 per year. We see in this example, at year 15, he's paid in a total of $270,000, that dollar amount right there. And his cash value is what? $265. So 15 years into it, he has less than what he paid in. So we're going to look at this on Excel as well. All right. So as we look at this guy, what do we see here? There's the basic whole life insurance policy, $18,000 per year. First year, $600. If we look at the total funding column, this will allow us to see when he gets his money back, which is between 15 and 16 years if he pays the premium every year. What I mean when I say gets his money back, by the 16th year, he's paid in a total of $288,000 and change, and he has $290,000. All years prior to year 16, he had less in cash value than what he paid in. So while he does have the life insurance, it's not a very good place to put his money. It would likely make more sense for him in his situation to just keep on paying into that term policy, which is $2,400 per year, and then put the other $16,000 somewhere else, even if he just saves it. Now, we also mentioned that he only needed that term insurance for how long? Or I should say the $500,000 death benefit for how long? Remember? 10 years. So, what he could do is get a whole life insurance policy, the same one, where he just stops paying into it after 10 years. Exact same policy, but he stops after the 10th year. We reduce the death benefit, so he still has life insurance after the 10-year period, and the buy-sell agreement is no longer intact, and the cash value grows. So we do see some value here. However, I probably would not do this. I wouldn't recommend it, nor would I do it for myself. So here's something we can do. For someone who is interested in a whole life insurance policy, but they don't like the fact that it's expensive or they have to commit to this huge premium, what you can do is minimize the premium. So what we can do is add what is called a term insurance rider, and we add this to a whole life insurance policy. And then by doing that, it's going to reduce the minimum premium. The follow-up question naturally would be what? Well, what's the minimum I need to pay in his particular case to keep $500,000 in life insurance for 10 years? And the answer, $3,200 per year, which is not that much higher than the term insurance policy he currently has. Let's take a look. So first we'll look at the illustration. We've got a lot going on here, but here's the main thing I want to highlight. The true minimum premium's less, it's $1,800 and change, but we need to pay $3,200 in order to maintain the death benefit of $500K. So as we look at the illustration, we see $3,200 per year. Cash value is not that attractive at all, $800 and change, but there's your death benefit, $500,000. The term insurance rider piece we mentioned. Here's the cost for the first year. The true minimum, the premium, plus the cost of the term. So it could be less than $3,200 initially. However, if we do want to keep the $500K for 10 years, we needed to fund at least $3,200. But you'll notice this, with the term insurance rider, we kept it attached for 10 years, and then we removed it. And when we removed it, the death benefit dropped substantially. So let's look at an easier breakdown of this, and we'll look at the same thing, meaning funding forever, and then paying just for 10 years. So what we're going to aim to do here is, again, reduce the premium or the minimum out of pocket from $18,000 down to as low as we can get it, which here, $3,200 per year. There's his initial cash value, not attractive. Break even will not be attractive here at all. It is 24 years down the road because really we're just paying the minimum. But if he compares it to term, he has something here in cash value. But then we've got this. The whole life death benefit starts out at about $50,000. Then the term insurance rider, add the two together, it gives you the net death benefit. This is what is paid out at death. If it's after the 10th year or after we drop it, that's what's paid out, the net death benefit in that dark brown. Okay. So that's funding forever. If he says, can I just pay into it for 10 years? The answer is yes. And here you go. The death benefit drops to a much lower amount after 10 years, but I paid a small amount for 10 years. I had my life insurance, and I still have some cash value left over. That gradually grows over time. Now, I will say that this is not attractive at all in my opinion. However, it is an option that demonstrates paying just the minimum, and we just looked at the illustrations. So with that said, the 500K in life insurance is important to him, but he'd also like cash value. So one brother asked about whole life insurance because he already has a life insurance policy. What he does with his is commit to the minimum and then adds more money to the policy, call it extra, in order to build the cash value. Going back to this question, why would I add more money to a whole life insurance policy? The answer is because it grows my cash value faster. I see the benefit there. So let's take a look at this. Specifically, we're going to look at adding extra money so we can see the benefit. Now, a couple notes first. When we add extra money, it's all going to go toward building the cash value, which is also going to grow my long-term death benefit. I'm going to have more life insurance as a result. A big reason he's interested in this as well, he doesn't want to just park money and let it sit and grow. He'd like to be able to use the cash value, specifically like a line of credit for his business, because a unique feature to a whole life insurance policy is that if the cash value is growing by, call it 5%, if I borrow against that cash value, I keep earning that 5% on the money that I borrowed. So it keeps on compounding for me. It's just like borrowing against a piece of real estate, and we're assuming that the real estate continues to appreciate every year. So if the value of that property goes up and I have a loan against it, doesn't matter, the value is still going to go up regardless if the loan's outstanding or if it's paid off. Very similar with the cash value life insurance policy. So what he asked specifically, he said, okay, I've got the minimum, $3,200 per year. That's not going to bother me at all. And I like the fact that that satisfies my $500,000 death benefit. However, I think I can easily do 10 grand per year. Can you show me what that looks like? And then also show me what it looks like if I stuff this policy. If I add a lump sum of about 35K, that's just money in cash right now, and then I fund 20K per year aggressively. What will that look like? Let's take a look. So we've got the illustrations here where we see 10K per year. Main thing I want to hit on here is you'll see that same minimum toward the top right, same thing with the term insurance rider, and the same thing here, same minimum, but just different payments here. I know this can be a lot. I'm really just highlighting this because this is the detailed illustration before I just jump into Excel for our friends out there that think we make these numbers up. All right, so adding more money. Here we go. We're going to look at 10K per year. So we've got as minimum $3,200 per year. Then we have what is called the PUA, stands for Paid Up Additions Rider. This is just adding extra money to the policy. An extra $6,800 per year through the 10th year. He can add it longer than that if he'd like, or shorter. He's not committed to the 10K. But by doing that, what happens? Well, instead of taking 15 or 20 years to get his money back, it takes 10 years in this example, which is not that good. It's a lot better than what we saw before, but it's not good relative to what can be done with a whole life insurance policy. There's the whole life death benefit. Do you remember what it was in the example where we only paid the minimum? Do you remember what this column showed in the first year? It was just over $50,000. That's at 66, then 81. This is going up faster, and the term is going down faster. When you add extra money into a whole life insurance policy, what it grows is this. This is why people add extra. However, it'll also grow the whole life death benefit. And with this particular example, when we remove the term insurance after the 10th year, because the buy-sell agreement, he's not going to need the coverage after 10 years. Now I've got more whole life insurance. You'll notice the net death benefit and whole life are the same once the term is gone. I'm not paying anything in. Cash value continues to grow, very close to 4% in this example, which if you do everything right with a cash value life insurance policy, cash value is a safe, liquid, and tax-free place to put money. Tax-free if we follow IRS rules and don't mess it up. But anyway, that's 10K per year. What's it look like if he stuffs it? Same minimum, but now he's saying, I got some extra cash and I want to stuff this policy. Let's have some fun. So by adding extra money into the policy, look at his cash value now. Almost $32,000 in the first year. That's more than 90% of what he paid into the policy. Paid in 35, he's got more than 90% of that payment in cash value in the first year. When did he get his money back or break even? Look at the total funding. By the fourth year, he's paid 95 and he has 95. See what's going on here? Why would I add more money to a whole life insurance policy? Because it gives me more money. Also accelerates the returns. Now all of a sudden, I see I've got a positive cash value, really by the fourth year, but by the fifth year, it's much more noticeable. Stopped after 10 years. He could stop after 4 years if he wants to, or he can keep going more than 10 years. His plan is to stop after about 10 years. That's why we're showing that model. But then here's the impact on the life insurance too. So he's got the death benefit for 10 years. After we drop the death benefit, look at this in year 11. It's close to 500K and it quickly recovers over time. And he's got that cash value that it can use for whatever he wants over time, whether it's for the business or whatever. So looking at this example now, what do we see? A lot more in cash value. Now, what I'll add about this too is his approach was to get a policy where he got a $500,000 death benefit first and then figured out how to maximize the cash value. You can do the opposite. A lot of times people will do exactly that, where they say, I want to put this much money in, maximize my cash value first. So if I'm paying just a total of 10K, make it look like this, where I'm cash positive by the fourth year or the fifth year, and the death benefit just minimized from the beginning. You can take that approach too, and now you're really calling the shots as far as you're saying, here's how much I want to pay in, or I want to commit to a minimum of this dollar amount, and I want to be able to add more money on top of it. You can do that with a whole life insurance policy and be very creative, meaning you don't have to have an agent tell you, here's the life insurance amount, here's the cost, and you can add extra if you want. No, if you and I flip positions and I'm interested in the cash value, I'd come in and say, hey, I'd like to commit to a minimum amount. Here's the amount I want to commit to, and then I want to add extra on top of the policy with the main goal of maximizing the cash value. Okay, let's wrap things up here. So, an important question to ask here, is my money growing? It's evident from what we just looked at, but can I examine it more closely? The answer is yes. And this is a really important point to add, because when you look at whole life insurance, there is so much information around how much it's growing by. You've got percentages like dividend rates, which never represent the net growth on your policy. Here's my favorite way to look at it. So, does my cash value grow? Let's look at one option at a time. First, with just the minimum. You pay $3,200 in the first year. Your cash value is $829. How much did it grow by? $829? No. Some life insurance illustrations will tell you that. You'll see a column that says cash value growth, $829 in the first year. It's like, that didn't grow by $829. I lost $2,371 because I paid $3,200. I only have $829, so I took a loss. I got less back than what I paid in. That's the yearly growth. By paying the minimum only, I lose money for the first 11 years on a yearly basis, meaning I'm getting less back than what I paid in. And then if I look at the total growth, I run a loss for 23 years. Obviously, paying the minimum only is not a good idea with a whole life insurance policy if I'm interested in the cash value. There's no way I would do that. All right. How about 10K per year? Same policy with that minimum of $3,200. We're just adding extra. First year, cash value is almost $7,500, which means I ran a loss of $2,500 and change. And in this example, while maintaining that death benefit of $500, I run a loss for the first 5 years on a yearly basis. So every year I got less back than the $10K I paid in. And I run a total loss until the 10th year, where I finally have more cash value than the total amount I've added to the policy. But I do see that the yearly growth and total growth accelerates faster than what it did if I paid the minimum only. And then lastly, if I stuff the policy, look at this, 35 going in, first year I've got about 32, so I lose about $3,000 in the first year. And then the second year, it reads 575. Here's what this means. In the first year, you were at 31,889. You added $20,000. What's 20,000 plus 31,889? It would be 51,889. But you're at 52,464, which means you got your 20K back and a little bit more on top of it. So that big lump sum accelerated the cash value growth, where now all of a sudden I'm getting more back than what I'm paying every year. This is where people look at it and say, wait a minute, this is a safe place to put money, grows every year? Yes. I can access it like a line of credit? Yes. It's also tax-free if I do it right? Yes. And again, no risk, like it's not tied to the stock market or anything like that. If we hyperfund it, that's where we see the growth really accelerate. I get beyond those early years and the pain point right away. And also see a positive return early on too. And this is all the exact same policy. He doesn't have to choose any of these options up front. He's got a lot of flexibility here to add more at his discretion. So to recap here, here's 3 helpful steps that he took and I think anyone can take as they look at a whole life insurance policy. 1, he took targeting the death benefit. In his particular case, the death benefit was important as it's being used for a buy-sell agreement. If you said, I don't care about the death benefit, I just want the cash value, I would peel this step out and just solve for the minimum amount of life insurance to make sure the cash value can still be used tax-free. But in his case, he wanted to target a certain death benefit first, then set the minimum premium. He wanted to know what that was up front, and then set it at that amount. This way, it doesn't bother him at all. He can hit that dollar amount, whether he pays it monthly, annually, whatever. And then 3, see the benefits of adding more money. And the last point I'll mention is I would always ask to see this before you start the policy so you can see firsthand how much better does my policy look like, how much better does it perform if I add extra money to it. I don't want to find out after I start, because if it doesn't look that good, I'm going to say I would never have done that in the first place. So I want to see it beforehand, and if it doesn't look great, continue to work with the agent to design the policy or have them design the policy where the cash value is maximized from start to finish. So with all of that said, I hope this helps. Please let us know if you have any questions at all, and thanks so much for watching. Talk to you soon.